Just the intraday low yesterday, while it wasn't a very wide range that the markets clocked yesterday, a very, very narrow band from the highs to the lows. But nonetheless, we got pretty close to even reaching that 19,600. Just about defended that level, and at the top we had that 19,700 plus level coming in. Having said that, the top drags continue to be the entire technology basket. Infosys led the decline yesterday. There was non-performance coming in from Reliance Industries as well. But yes, that got sort of balanced and a bit of a seesaw there from ICICI Bank and Bajaj Finance on the other end. So pretty volatile a day. But again, on closing, we were absolutely flat for ourselves.
See, markets are getting tired, Aisha, to put it very simply. There are times you have trend in the market. The trend could be strong, the trend could be weak. There is momentum. The word momentum can be addressed with markets on the upside and also on the downside. So what appeared like a reversal, let's say, late last week or middle of last week, that has not translated into any kind of a snowball effect. So markets are simply tired. They are marking time. You are seeing some give and take which currently is happening. Banks which were supposed to lead the market action, they've not obliged. Reliance was never in the race. So the Nifty right now is bereft of leadership. There is a time-wise and a price-wise correction which has kicked in some of the railway, defense and some of the power stocks. So this market is simply marking time, waiting for the next cue. The queue, I reckon, would be centered in and around the earnings season and the commentary which we will get from companies from the festival season. Remember, this time Diwali is late. So there is a lot of festival and pre-festival indications which we will get from companies in middle of October, and that's the time you also will have your earnings season. So what we are staring right now is a market which is lacking direction, which is looking tired, tired. Suddenly in mid of October, the market may just give you a very strong direction, a very strong move on the upside or downside. That's debatable. But for the moment, I think it appears that for next 2 weeks, the global Q is pretty much status quo. You've heard from Fed, Reserve Bank of India will not move. Those are at best patchy. So there is no inertia in the market, and this is typically a tired market or a phase of the market there where bulls are also saying that, guys, let's take a break. It's just one of those phases.
Bulls and bears. I mean, looking at the index level yesterday, which was just so flat.
See, bears were never in the game.
Yeah.
Frankly, bears have never been calling the shots with, one or two brief, patches
Sectors, yeah.
in last couple of days.
Yeah.
But the bulls are actually saying what our producer tells us, time to take a break.
Yeah, but that's exactly what I was checking out as well when it comes to the kind of data that we've got overseas. Nothing really much in terms of cues on Wall Street, but we did manage to wrap up yesterday's trading session for Wall Street. That snapped that 4-day losing streak, so managed to end in the green. In terms of the Asian markets, there's inflation data that's coming out across the region, so it is looking a little bit tempered and a little bit choppy when it comes to the Asian screen. But more importantly, the other cue is the fact that is at about $93 to $94 a barrel. You've got the bond yields which have continued to rise further, so close to 4.5%. So in terms of the global setup as well, I guess, Nikunj, is there indications, given the way the dollar index is at, etc., as the other indications that it is in a bit of a pause mode?
See, Brent and dollar index, they're both going high. Technically, it's not great news. We can, there is enough and more reasoning why strength in dollar index and strength in commodities in the short term is not good for emerging markets, and I think that's visible in the way if you look at flows. We look at last week's data in terms of market flows. India is outperforming, but even though India is outperforming, the flows have been negative into emerging markets. Dollar index is at 106, but remember last time when the panic happened, the dollar index was at 115. So dollar actually can move higher, given that right now money is moving back into treasury, where treasury yields are now nearing 5%. So we are going through this periodic adjustment in the market where the Fed commentary has changed. There you go. That's the flow. I think this is typically when the dollar index is strengthening. So the impact of the dollar index, I think, is visible in flows. I don't think anybody is really worried about this sharp uptick in yields, because that is something what markets have learned to live with. But I think in the near term, this pressure on flows will continue because a lot of money allocators I've spoken to. I was at a investor conference last night, and the sense I've come back with is that they like India, they love India, but they want to buy India at low levels. Also, some allocators are saying that if you're getting 4.5-5% plus risk-free return in US market, why do we risk? Why do we chance our arm? So that kind of positioning change, I think, is visible, and I think it really could happen for next couple of months more.
Yeah, absolutely. Okay, let's just talk about some of the sectors and stocks that have been weighing heavy in on the markets. And one case in point has clearly been Reliance Industries. Just any news flow doesn't seem to be really lifting up the stock. And if I were to just talk how the stock has been panning out, it's fallen for a 5th consecutive session. Not just that, looking at the technicals, it seems that it's now getting into oversold zone.
See, Asha, I know everybody's talking about that underperformance in Reliance, but I beg to differ. I say that okay, you're looking at the underperformance in Reliance, but then you go to add back the value of Jio Financial Services. That's a good need 250 rupees. Yeah. So you add that 250 rupees, then the picture for Reliance is different. So that's one point. Second, yes, if you look at Reliance in isolation, which is what you need to do, it has not really participated. And B, in the near term, I've always seen with Reliance, and since there is so much of rich history available for Reliance, that when the company has always announced a large capex, the stock tends to underperform. And last AGM, they announced a large capex, and another 2 years that capex will start. So that, in a sense, has really been a factor why Reliance historically underperformed. So the way Reliance has historically moved, that will give you 2-3 years of underperformance and then one or 2 years of big move. So I think it is just getting ready for a big move. Now, whether that happens this year or next year, that's conjecture. But I think that's how typically Reliance has moved. Also, in terms of the fundamental factors, well, GRMs are not that strong. The global demand is not that interesting for the OTC segment. So there are other fundamental factors also which are at play. But for markets to move higher, I guess Reliance has to move higher. The more Reliance will consolidate, the cheaper it will get. I guess this is one heavyweight which in fact can really do the trick. Just think about it. You get HDFC Bank back up and Reliance back up, the Nifty could be very different. Absolutely. But the problem is between Reliance and HDFC Bank, it's a good 16-17% index. Actually more. HDFC Limited and Reliance is much more because the combined entity is much more. It's north of 20. If they both come down, it will have an impact on the market. And if they both flip, we are looking at an upside. So a lot actually hinges on these two stocks which will determine the near-term direction.
Yeah, the heavyweights really pulling back.
It's about 14.5%.
HDFC and HDFC combined, and then Reliance would be about 10.
14.5% is HDFC Bank, Reliance is 10.8%.
Yeah, so that's 24%.
Yeah.
That's quarter of index.